Everyone thinks the stock market is insanely overvalued right now. They point to one number, the Buffett Indicator, in saying US stocks are 213% of GDP. Sounds terrifying, right? But what if I told you that number is completely misleading and maybe even mathematically broken? The Buffett Indicator compares the total market value of US stocks to the size of the US economy. It worked beautifully in the 1980s when US companies were basically American businesses serving American customers. But today, that world is gone. Over 40% of the S&P 500's revenues now come from outside the United States. That means the Buffett Indicator is comparing global earnings to domestic GDP, apples to oranges. So when analysts scream that the market is 213% of GDP, they're missing something huge. Let's fix it. If we adjust for how much of global output is actually produced by US companies, the picture flips. US corporate businesses produce only 15.5% of world GDP, about $17 trillion out of $111 trillion worldwide. So America's share of global value creation is far smaller than the raw Buffett Indicator assumes. When you account for that, the Buffett Indicator crashes from 213% to around 83%. Boom. The overvaluation vanishes. Warren Buffett once called this ratio the best single measure of where valuations stand. But even Buffett couldn't have imagined a world where Apple earns more from China than from California. In a globalized, digitized, AI-powered economy, GDP borders mean less and less. The markets have gone global, but the Buffett Indicator hasn't. So next time someone says the stock market is in a bubble because of the Buffett Indicator, just remember, they're using a 1980s map to navigate a 2025 world. And that's why context beats headlines every single time. Subscribe for smarter investing insights.